But you do have general topics, frequently asked questions, myths, mysteries, and misconceptions. It's at the top.
Yep.
Should we tackle that, or did you have a different idea in mind? I only say that because last night I had a conversation with a friend of mine who has read the book, who has listened to everything I've put out, and still came to me and said, can't you do all of this with an IRA just as well? And I'm like, how much have you listened? Even though, you know what I mean? Like, there's just this, I was like blown away. You have listened to everything and are still saying that. So we walked through the pros and the cons of that. Mostly cons. Every pro he came up with, I was like, but what about this?
I think James Nethery says it's never a problem until it's a problem. I had a client just yesterday where they were using a HELOC, business line of credit. And to do something similar, they didn't know they were doing this, but they were doing something similar. And they changed like from one checking account to another, like they closed one down and opened a new one. But the line of credit was linked to the one that was closed. They tried to take a payment from the old account, which didn't work. So it froze all of his accounts, which stopped his like part of his business. He had to go into the branch to get everything like remedied, and it was like perfect example. Like they have more control than you think when you sign on the dotted line. It's not just they shut down they control the collateral. They control way more than you think they do. But it just feels so easy. It's so seamless. It takes me 2 seconds to open a bank account. What are all the agreements that you're checking off on? Like people
that no one's reading,
that no one reads. Somehow we're all held accountable to. That they're all 7 million pages long and in language we can't understand. And another example, someone had just a bank account. This is someone outside the US. They had a bank account. They wanted to withdraw like 2,500 pounds. And they would not do it. They're like, what do you need the money for? It's like, what?
2,500.
Yeah, I have a budget to buy a motorbike for my kid or something like that. He's like, yeah, but do you have proof you're going to buy it? I was like, what? Are you going to give me my money or not? Like, what? It's
my money. That's what we think.
Remember,
right?
it's not your money when it goes in the bank.
That's the problem. Yeah.
They don't realize you exchange it for a promissory note.
Yep.
It's not your money. It's not your dollar bills are not sitting in a stack on a shelf somewhere. You're never going to see the dollars you give them. You'll never see those serial numbers again. It's not your money. And people don't realize it because it seems so fluid. But yeah, it is. I can go in and get my money whenever I want.
It's so fluid until it's not.
Until it's not. And then your rights that you thought you had that were like luxuries, like the right to your access to your capital, the control, the custody of your capital, when you find out who actually owned what, you realize you gave away all of your capital for this in that moment, this worthless promissory note. You can't get your capital.
And that's not even when there's like a big problem, right? So now you sell that out to where the bank might have a problem, and now you have a bail-in versus a bailout, and guess what? You don't have any capital because the bank has it all, and you may never get any of it back.
Yeah, that's huge. It's like in a lot of ways when you can't, so you have a line of credit or you go to get a line of credit, you have an 800 score, 850 credit score, and you can't get credit. Effectively, that means the interest rate is infinite. Like it's like you can't even use it. You can't access it.
I recently had a situation with that with one of my clients is a real estate investor. He has like 20 properties. His credit score was too low because of some of the stuff he'd been doing with, moving stuff around so much. And then he's like, I've got like $500,000 in equity in these properties and I can't touch it. They won't let me.
Wow.
Yep. IBC actually bailed him out because he could access some capital. And he just started a year ago. So
Yeah.
that wasn't bad. You know, he had something.
That's so important. Like
And
people
it was a
under
real aha moment for him. He was like, wow, no kidding, you know?
like no one's coming to turn the lights off. No one's freezing assets. No one's telling you to make payments. No one, like they don't have the right to.
Mm-hmm.
Like you're ironclad. They don't have the right to tell you that. There's nothing else that gives you that level of control. Nothing.
Yeah. Yeah, I love that joke. That's like it's contractual. Like private party contract says they don't have the right to do any of that. And that, I mean, that's freedom when you have complete autonomy to do things the way that you want to. I mean, how much better is that than all these different rules? Oh, you decided to try and elevate yourself by getting these extra properties, like Tricia's client's example, right? And because they're doing it, they're exercising what they feel is right to help grow their business, do whatever they're doing. And that drops the score by their rules. And
Mm-hmm.
sorry, no, you can't. Yeah, you might have all this, but we don't really care.
Right.
You don't tick the box, so you can't do it. And I mean, that's just sad.
I mean, you can't blame, like it's a business.
Mm-hmm.
And there, when we introduce multiple businesses in one equation, all of them are fighting each other for their own
Best
like
interest. Mm-hmm.
best interest share for the shareholders of their company. As long as everybody stays in line, it all seems to work fine. It's when we even move a little bit outside of that line that, like, wait a minute, that's not what's in best interest of my, and all of a sudden it gets real tight real quick and everyone starts pulling back. It's like, whereas the beauty, and I say this all the time, it's not, talked about enough. Mutuality means the insurance company and you are the same. Like you
Mm-hmm.
own the insurance company that is the custodian of your capital. Like it's the same entity. So when you decide to do this, there's no line. It's one. Nobody's fighting anybody. You're doing the same. We're rowing in the same direction. There's no combating. Like Tricia just
There's no
said,
opposition there.
interest.
Yeah.
Exactly.
Yeah. That's a good way to think about that.
You're on the same side of the table every time.
Mm-hmm.
Mutuality is such an important part of that equation. And like, if you want to take it back to the Bible, I said this to Jesse before. The the best example of mutuality, I think, is Jesus. If you think about the fall, Adam and Eve, right? They were in union. They were on the same side of the table with God. Stuff happened. They're off. They're on the other side of the table now. God, and the way they did that was Adam chose to listen to his wife above listening to God. So he put flesh above God. He put his interest above God. That caused the fall. They're on opposite sides of the table now. To fix that, God says, I must become man because man puts man above God. So if I become man, then man is putting God in man form above, right? So now the order is restored. So now we're both on the same side of the table again. Mutuality. God's fixing the opposition that Tricia said by creating mutuality.
Mm-hmm.
Well, it closes the divide, right? With
Yeah.
I mean, it just because when man fell, it created this massive divide that could never be crossed, and by Christ coming as a man and then dying and wiping that out, close that divide, and now we're back in that mutual state when we choose Him.
Or when he chooses us. Let's go back to Jesse's.
Well,
Drags us for
ultimately,
kicking and
yes.
screaming.
It's up to us to respond to that, right?
He draws, he calls all men unto him. He draws all men unto him, and then it's up to us to respond. It's up to us to step up to that table, to the offer that he's made freely to everyone. Y'all great, and I love where this has gone.
But we should probably start, right?
Yeah, we can start now.
Yeah, we've already started. I love that. Do y'all want to lay hands on a second topic? I love yours, Tricia. We'll field that one about can't you just do this with an IRA? You know, out of that list or out of anything else from, you know, your world, is there one that y'all liked? Looked like you had a thought, Tricia. Was there another one?
I do, but I don't want to be the only one throwing it in here.
No,
I
tell
guess
me,
the other
please.
one, the other big one I've been getting recently from people is that, I mean, it's a typical question. It's so it kind of falls under your frequently asked questions. Why would I want to put my money someplace where I've got to borrow against it in order to access it?
So particularly the borrowing aspect, huh?
Yeah.
Okay.
I think that hangs a lot of people up, especially if
It
they're
does.
Let's talk
ingrained
about
in
borrowing then. That's
anti-debt, cash, that sort of thing.
all right. Let's talk about borrowing. Awesome. I love it.
So give us the start of this one conversation, Tricia, where you were talking about that conversation you were having with a client or a prospect or a friend or whoever about, well, can't you just do this with an IRA? So just tell us again, you know, what you said what they'd done.
Well, this was a gentleman. He's older. So he's struggling to see how infinite banking would work for him at his age anyhow, but he has, you know, accumulated a lot of assets and money in IRAs. So he came to me and just said, hey, I just wanted to find out, can't you do this same sort of thing where you borrow against your IRA and use the money and pay it back and all of that, right? Like, isn't that the same sort of thing, just a different product? And then he did kind of say, oh, well, yeah, it doesn't have a death benefit, right? But I was trying to remind him that, you know, there's also rules with the IRA, right? Any qualified plan has rules. You don't get to set the terms, you know, you don't get to set the payback schedule. The tax consequences are different, all of those things. So that's kind of where that conversation went. I don't know if that answers your question.
Yeah, thanks. Go ahead, Joe.
Yeah, I just want to clarify. He has IRAs or is he still working?
No, he's retired.
Okay, well, all right. So for those listening, if you have an IRA, you can't collateralize it. So number
I
one,
think
you
he was
can't.
borrowing from it, or saying that the younger person, he wasn't necessarily talking about himself, because obviously at his point in life, he's taking distributions, right?
So I just wanted to share an IRA, from a traditional IRA, you can't borrow. You can do what's called a 60-day rollover, where you can take a certain amount. You have to put that amount back into the IRA in cash, but you can't borrow from an IRA. You can't collateralize it. It's against the IRS. Part of the IRS code is these types of accounts cannot be collateralized. So there isn't a way to borrow from it.
Different from a 401k then.
A 401k, they call it a loan, but it's not. They take your capital out of the market of whatever you're invested in. They take it out and give you a qualified distribution that they call is a loan.
Mm-hmm.
Then they take a portion of your paycheck for the next, say, 5 years. You don't get to choose. And they say, we're just going to take this amount till it's paid back.
Mm-hmm.
So you're taking pre-tax dollars out, and then you're paying it back with post-tax dollars. And then when you take it back out in retirement, you get taxed again. So it's like, they love loans, or like the IRS, sure, take a loan, a loan that we're going to get double the tax money on.
And if you wanted to compare the two, when you take that money out, that money is no longer growing.
Yeah.
Like it is with infinite banking. There's so many of these little nuanced pieces to this, right? That people don't understand because all we have been taught is qualified plans. And I guess that's the, I don't know, frustrating thing for me, or the challenge is it's a mindset. It's the pre-programming that is so solid. It actually blows my mind sometimes how difficult it can be to challenge that thinking. And because, like I said, this is someone who has read the book, who has really studied this and tried to grasp it, and yet it's a challenge.
I think a lot of that though is very psychological in
Mhm.
that when you're challenging someone's core beliefs about, especially if they're not rooted in like their faith really strongly, you're challenging their entire belief process and concept. So in what I mean by that is they're in a situation where everything they've known to be true might be wrong. And that's extremely frightening for some people. So they would rather hold on to what they think is true as
Mhm.
opposed to embracing the truth. And it's hard. Some people will never let go of that. Other people are, and I would say people who tend to be a little bit more skeptical about what they've been taught. And I see more and more of that happening nowadays where because they see some of these cracks in the foundation of the, you know, the fundamental understandings or underpinnings of what they believe to be true.
Mhm.
And they're a little bit more open to it. But if you're not, grounded to say, okay, well, this might not be true, it's really scary for people. And
Well, yeah, and I would say this is even a gentleman who's very favorable to infinite banking. Like he says, I think it's a fantastic thing. I wish I would have known about it years before, right? I'm just saying there's just still that confusion there a little bit. And so, but that's a very interesting point that you bring up, especially with someone who has lived with this for years, right? It is hard to think, oh, how did I not know about this sooner? And does this challenge everything that I have been working for 40 years plus, right?
mhm,
Yeah, I definitely see where who we're talking with can make a difference, right? Because if we were sitting down with somebody who is from the generation before us, or maybe even the one before them, they saw the generation before them do things a certain way and it quote unquote work, right? Like more or less work. They played by the rules in the system of the day, and they got the gold watch, they had the pension through the company, etc. Right? So that mindset, that psychology, that process, I would say process, is still trying to be imitated and implemented by that generation that's above us, let's say, and then our generation, etc. But the products might be different. Maybe it's not a pension so much as, it's IRAs. You're making me think somebody, Tricia, who worked for himself, business owner all of his life, hard worker, did great for him, family of entrepreneurs, and yet he decided to put a lot of his money in IRAs, which I thought was terribly interesting because he's there running a business for one thing. So they're still operating under that thinking that, okay, well, this is what we're supposed to do because that's what we saw done in the generation before us, but maybe the products are different. So I guess, I've written down three things, three attributes, three characteristics that y'all while I've just been sitting here listening, three things, and they all start with the letter C, which is interesting, or maybe I put that part on it, that I think we should talk about, and just let's walk through. Okay, when it comes to product, because it's a worthwhile discussion, what are the attributes, what are the characteristics of the IRA, the real estate, the whatever, the 401k? We talked about the 401k a second ago, Joe did. That's a worthwhile conversation. But if we could take one of the characteristics and go back to the process of banking, I think that is the starting point in really shifting or having an opportunity to shift someone's thinking around what infinite banking is all about. Because I think it's worthwhile to just look at, okay, here's this product, here are its characteristics. Here's this product, here are its characteristics. But why do we have those? What are we looking to do with those? What's the process at large that those products are playing into? Because we're either going to do conventional financing, meaning purchasing, buying, spending, banking, or we're going to do it privately. by implementing infinite banking. So if we could take something like control. So here are the three that I got from y'all so far. And then Joe, I see your hand raised, which is just funny. And it's not. I get it. Protocol, politeness, control, collateralization, and compounding. Those are three things that y'all have mentioned so far. And I think there are several more, but control, collateralization, being able to collateralize this product that you have, and then compounding. All right. So if I just said what I've heard y'all cover so far is some products allow you different levels of control. Some products allow you to collateralize them, and some don't, meaning they might have a value, but it's a paper value. And it looks good when somebody else says it looks good, and it'll qualify for them to give you access to capital or not, right? And then compounding, like when you had mentioned about, well, okay, if you do take a 401k, the money that you did have in the 401k, it's not compounding anymore. So you've interrupted that. So that's where I'm at in just hearing where y'all are in listing the attributes of the products. What do y'all think about which you want to tackle first, maybe? And Joe, I'll just kick it over to you, but I'll tell you, this is my question. Are we talking product? Are we talking process? Are we talking both? And in what order?
Go ahead, Joe.
Yeah. So I'll just address my opinion of that first. I think if you address the actual problem first, that will lead you to various processes. You choose the right process, that will lead you to various products. It will lead you to the right product, right? So if you get the problem right, you'll pick the right process. If you get the process right, you'll pick the right product. If
What's
you
the
try and do
problem?
if you try, I'll tell you, it's like, if you try to do it the other way, it's the tail wagging the dog.
Mm-hmm.
You're chasing too many, like you don't know what you're even trying to
Yeah.
get
Trying to solve. Yeah.
Exactly. So that would be my 2 cents there. I want to take a step back and go back to like the 401k qualified plan idea. For the listeners, if you're not entirely sure what that even means, you can think of it like suspended spending, meaning you're taking your dollars that you've earned today and you're putting them somewhere where it's suspended, it's not taxed, it's like kind of ignored until you get way out into the future. You'll do that, you'll wait like 30, 40, 50 years, and then hopefully that's a really big paycheck that starts coming to you. One of the first names of the 401k plan was a deferred compensation plan. So you're deferring, you're pushing your dollars out into the future. So when you receive them, you should expect that it's going to be taxed like your compensation, like a salary. So ordinary income. It does not have a capital property. It's not like when you invest in a normal, like a stock account or brokerage account, you buy in, there's a cost basis, and when you sell, there's capital gains and stuff like that. Does not happen because it's still ordinary income. In this wrapper, it preserves that ordinary income treatment. There's zero cost basis.
Mm-hmm.
And just you mentioned the paper value. I could go down a rabbit hole on this, but if you look at your qualified plan balance, that's not the actual balance. That's not the spendable balance. Depending on how you access it and when you access it, what you can actually spend from that number changes. For example, if you're in your 30s and you try and take money out, you're going to lose taxes. There's a penalty, etc. So the value shrinks dramatically. If you try and take it all out in one lump sum, it shrinks even more because you pay more taxes. Remember, it's like a big paycheck. If you try and spread it out, the value is a little bit higher because it's less taxes. If you try, so depending on when you try and take it, if there's maybe an exclusion that you fall under, a portion of it could be exempt from a penalty. But so like the value that you see on the page is pretty meaningless. It's
And
not spendable.
I remember when I got access to mine, the day I took it out, you have to wait and see what the market value is at 5 o'clock that day.
We have an estimate, but we'll know at the end of the day what your actual value was.
Right. Which introduces the idea of risk into the whole equation.
Oh, goodness. It's across the board. It's nothing but uncertainty.
Right.
Okay, going back to the question was, what do you start with? Problem, process, product. I said problem leads to the correct process, which leads to the correct product. Back to you, Jesse.
Okay. Well, I added another C characteristic to our list, which is certainty. Which I shouldn't use that because that's not necessarily the same thing as risk. But I was just trying to see how long I could go
Keeping it alliterated, right?
Well, that's the opposite of risk.
Right. Exactly. Well, which is exactly what I would say, infinite banking is providing, is the exact opposite of what is going to happen traditionally with conventional finance.
Sure.
Well, I'm glad that you brought that up. Just one more nail in the coffin to me, Tricia, about the waiting until market closing time to actually see where we stand today, because nobody knows. I love that. And then I love, Joe, that you brought up, I think all these names are, if we actually think, which people don't, we just, we're showing up at the job, working for the company, filling out the papers that HR gives us. We sit in the conference room once a year where they walk their people in front of us to talk about the government qualified plans and all. Like for the career people, like that's what that looks like. That's what it looks like, right? And then we've kind of already been talking about people that work for themselves that then decided, well, hey, maybe I should have more diversification than just what I'm doing in my business. So I better go get some IRAs or real estate or something or whatever, right? But government qualified plans, I think if we do take the time to just see what they're telling us, government qualified. If you just ask somebody on the street, just walked up to them, right, like Mike on the street kind of scenario, hey, do you want the government calling the shots on how you run your life? I think most people are going to say, no, I want to choose. I think they would, okay? I think if you ask somebody, would you rather have your compensation deferred today? Would you rather take home, hey, Rob, it's payday. Do you want all that you earned from our company, or do you want to put some somewhere else? I think in the moment you'd say, no, I want to take it home. We're getting groceries this weekend, or it's just like whatever you're going to say, right? No, we're going on vacation this next week. I want more money now. I think most people would say that. I think they would say, I don't want to be. So just recognizing that money was earned by the individual and somebody else is taking it somewhere else, and then the taxes and the penalties, all those aspects start applying. There's power in knowing the words and thinking that through.
You're hitting on an interesting point, Jesse. So think about it. I think another way to ask the question is, do you think you can make better choices with your money than the government, or do you think the government can make better choices with your money than you? Like, do you think that? And most people are going to say, well, I can make a better decision because I'm not the one who's, $35 trillion in debt, right? So that being the case, maybe if you had the money and you had the choices, you can probably make a better decision with it. Not only that, I don't want to go too far down that path of the product, but I think that's a great starting point to ask the question where, who makes a better decision with your money, you or the government? And in a government qualified plan, they do set the rules. They're the ones making those decisions. They give you the illusion of control, but you don't really have control.
Rob, I would actually argue that I think the average American doesn't feel like they can do better with their money. Which is why they trust Wall Street. And I think that the government has played upon that and kind of in order to, you need to put money aside here because you are not trustworthy enough to set your own money aside and prepare for your own quote unquote retirement one day. So therefore, we're going to do it automatically for you. And we're going to invest it in these mutual funds or whatever. And so we're trusting that those dollars are better taken care of by somebody else, and we're not trustworthy to handle it. So therefore, we should not touch it for 40 years. And I think that's just a part of like a lack of financial education in America, not realizing, that's the way I felt until I started doing something with real estate and my eyes were opened like, oh, I really can do a lot more by myself. And I can know what I'm doing and I can mitigate the risk of those dollars because I can control it, and I can have the education to know that if I invest and put this money and purchase this house and rehab it and flip it, I'm going to do okay. So that kind of opened my eyes to, I don't have to just put it away. And in fact, it changed things from, I needed 40 years to have enough money to be able to retire. And I don't even like the word retirement. So every time I say it, I'm kind of cringing because I want to just enjoy my life the rest of my life. But I can do a lot more if I have access to that money in 10 years or 5 years than stuffing it away over here and never touching it. It's like I always think of that as like you're handcuffing me. You're putting my money so far away from me that I can't do anything with it except for take the risk and hope that this mutual fund is going to do okay.
Yeah,
So
real
I do
quickly,
think
and then
it's kind of like, I think there is a real lack of confidence in the majority of American people to actually do better. And the government has kind of pushed that idea that, your children, you're not capable. And we've bought into it.
yeah, I was just going to add to that, Tricia, because I think you're right. You're spot on. But I think it's more so that people are taught to think that way.
Yes.
And it's done on purpose. And that's the part that most people don't understand is you are taught to think that you are not capable of managing money
Yep.
and you are not capable of doing better than anyone else. And you need to put that in our control. We'll take care of
That's
that
right.
for you. And naturally, people tend to be more complacent. So they're willing to give up that control. But and then one side note to that, I also think people don't want to take the responsibility that if it doesn't go well, they're the one who's on the hook. So,
Mhm.
but that's why going back to Jesse's point about certainty, well, there are things that have certainty, but we're just not taught to look at those. And if we are, going to the product side of things, then people chastise that from those communities that want the control over your capital. So I think that's a way to kind of tie a few of those things together. Joe, you've had your hand up and you look like you were itching to say something before, so go right at
Sorry.
it.
You're too polite, Joe.
Yeah. I think so. If you back up to some of the things you were just saying, what about, so if we're going to take whatever the recommendation is, 5, 10, 15, 20% of your income and defer it, we can't use it. And remember, your income is theoretically growing every year for the next 30 years while you're working. So that 20% is getting bigger and bigger that you're pushing out there. What about the loss of experience that you didn't go on vacation with the kids or go to Europe or just normal everyday things? You didn't do that rehab, or not rehab, but like I didn't redo the kitchen the way I wanted it earlier in life. Like there's this, like you only have so much time and health to use your capital. Right? We only get so much time on this earth. So if we take this and rob ourselves for 30 or 40 or 50 years, like
We're not
you
living.
have to, we're not, so you have to deduct the not living from
Mhm.
your return that you got in there.
Well,
And
that's
going back,
the
like,
opportunity cost, right? That's part of it.
And
yeah, that's part,
yeah,
yeah,
the
absolutely.
system promotes for one day, someday, not any life now, or very little life now. Take your 1 or 2 week vacation a year. You're done until 65.
Yeah, and I mean, I'm making it, yes, the system like doesn't care that you have a kid. You only get a couple weeks off. It doesn't care that your parent passed. You only get bereavement for 5 days. It doesn't
Yep.
care that like and I'm getting off track, but if you go back to your question where it's do you think you can make better decisions with your capital for you than the government? We can look at like Okay, let's look at the big government program, Social Security. I don't know if anyone heard this, but it's about to go bankrupt in, I don't know, 9 years, unless some big changes happen. Yeah, that's what we want.
Yeah.
They took in actuarial science and bastardized it and screwed it up. Like the most solid financial science we have, and they messed that up. Compare that to like a business owner who I think Jesse was saying a little bit earlier. This business owner was putting money, trusting the government, putting money into these programs as much as they could. Where if you just stop and think, where's your greatest return on equity? If you do that, you can't expand your business. You can't hire, Rob to do this such and such job, or Tricia to do this marketing thing over. Like you can't expand. So you're handicapping the growth in your highest leveraged return on equity, return on capital thing that you've built, and you're putting it in what? Tricia called it a little jail.
Mhm.
You can't access it for 30 years. The capitalization period of a 401k is 20 to 30 years. Which, by the way, it's kind of funny that people get upset with a 4 or 5 year capitalization period
Life insurance, yes.
of a life insurance. They willingly give 20% of their capital to something they can't touch for 40 years.
Say it louder, Joe. Yes. Oh my goodness, that's such a great point.
One of the, like, Tricia hit on this, like, she compressed time when she had control of all of her capital. So another way to say it, the scale of your capital compresses time. Right? I like to say frequency is more important than volume, which is more important than rate, which is more important than time. But if you were to look at like a modern financial planning setup, time is the most valuable thing. Then rate, right?
Mhm.
Volume, they say just start early. Like
Yeah.
they totally
Mhm.
diminish, like it's the reverse order. But I'm like, if you have enough volume, we compress time.
Mhm.
Like we can even if the rate's small, if you have enough volume, it doesn't matter. We can compress the time and the rate they don't matter. If you have enough frequency, even the volume can be small, but if you do it multiple times, again, the rate and the time don't matter. The least important stuff is what everyone focuses on: time and rate.
So run that hierarchy by me again. Frequency is greater than volume. Volume's greater than.
Rate, which is greater than time.
I heard a really
Rate.
good one not that long ago that was just saying like, picture the number in your head that would create this level of financial security when you're in your passive income time, right? And you have that. Let's say you picture yourself there. Did the rate on what you earn get there matter? No, it didn't, because you have what you needed. So it's more important to figure out, can I take a vehicle that allows me to get there and don't worry about what these rates are? Because you're getting it takes people off track of what the real goal is. And it ties back to what you're talking about was volume, Joe. Like you have to have the volume going, and then the time can compress, like you were saying, and then you layer in frequency of using that at the same time. I mean, it changes the game.
The yeah, that's a great that's a great little exercise. If you had all the money you needed, did the rate you earned to get there matter? Like, no. If your capital never stops compounding through compounding, it never goes down, it never wavers, it never wiggles, it never goes down, it only goes up through compounding. If it never stops compounding and you can still use it, or an equivalent value you can use, we have the volume piece of this. The biggest lever we have one of the biggest levers working for us.
Well, yeah, I was going to say that's one of the things that I think I appreciate about infinite banking that people don't quite understand is that when you are putting money away in a qualified plan and you only put in 5%, even with a match to make 10% or whatever that is, right? That's pretty much all that people are doing. And then they're putting it in a vehicle that doesn't do true compounding because it does have risk and days of loss, in there. So they've got the small volume, they've got the risk as well. With infinite banking, you can put in such greater volumes of your income because you can access it, right? So you can use your cash flows and put in 2, 3, 4 times as much as you'd be able to put, and as Nelson says, eventually 100% of your income. So now you've got the volume piece, plus you've got the growth that never goes backwards. So I think you have such an advantage there. And on top of all of that, the ability to access it means that you can now go and invest it as well another time, right? So you've got the velocity, the frequent use of being able to use those dollars again and again, and potentially in other investments, or to live your life.
I think if we go back, just go to the part where Tricia's saying it's compounding and you can access it. If you put that up against these other options, like maybe the Roth IRA does great or your 401k does great, maybe.
Mm-hmm.
But the minute you go to use it, you've stopped the compounding.
That's right.
It's just like when you put cash in your savings account and then you take it out. The bank is not paying you interest on those dollars ever again. You spent them. They're gone. They're done working for you. It's like that dichotomy where you have to choose compound or spend doesn't have to exist. There can be an option where you're compounding while spending. That's the option that allows you to, as Tricia just said, live. Whether that's just live, or whether that's I want to be a real estate mogul, or whether that's I got to clean up some debt, or it's just lifestyle spending.
Or it's I want to take my kids on vacation now and not wait until later to be able to do things that are relationally important because we only have so much time on this earth.
That's perfect. Okay, so picture the family that they have young kids. It's like, oh, wait, we can't afford to go to Disneyland. We've got to wait 7 years. Now the kids are like 18. It's a totally different experience. It's a different experience. The magic is gone from when they were like 4 and 5 and they just saw Mickey Mouse on TV for the first time.
Yeah.
As an example to show the timing, that's another thing. Timing matters. It's not just time in.
Right.
Just because you could check the box to say I went to Disney World when they were 25.
Yeah.
It's a totally different experience than when they would have gone when they were 5.
Yep.
Timing matters.
As a mom and a former kids ministry director, that was a huge thing, like an eye-opener for me, is that your kids are only, you may have I have a granddaughter, Mackenzie. She's only 9 years old for 1 year. That's it. She's no longer going to be 9-year-old Mackenzie. It's going to change. And being able to grasp that time and not lose that, being able to, I guess for me, that's what a huge thing is, being able to use money, not for the sake of just having money, but for the sake of being able to do the things in life that matter the most with the loved ones you have. That's a huge piece for me.
And as stress-free as possible.
Yes.
You don't have to feel guilty about going to
Right.
Disneyland or getting
I'm giving up end of life stuff in order to do it today. No, I get to do both.
You could do both.
Yes.
Can I jump in here with my screen? Can I try something for the first time? I've never done this, and there's probably a good reason why.
Go for it.
Tricia, 3 or 4 times you've said something Yeah, 3 or 4 times you've said something about, I wrote it down. I want to live my life for the rest of my life. So it just made me try to visualize. I like some kind of visuals. That's why I'm going to try and do this. And I can always cut this out if this doesn't work for me. But okay, but I saw in my mind, I saw in my mind a ditch over here. I'm going to call this the YOLO ditch. Right? And that's the person who, like me, even me, while I'm sitting here, I'm thinking about, oh my goodness, my Jacob's about to be 12. Oh my goodness, Malana, didn't ask me to carry her, y'all, into church for the first. If you've seen me on social media, you've seen me taking a Sunday picture. All right, she'll be 6 later this year. This past Sunday was the first Sunday for her whole life that she didn't turn around halfway and say, "Daddy, would you carry me?" Didn't happen. Hurt me in a bad way, in a lot of ways, right?
Aww.
Yep, it did. But it's beautiful at the same time. I can appreciate that. But what I'm saying is I'm hearing you describe what you're saying, Tricia, and you feel this too. And I'm thinking, that's exactly what'll make a person pick up a credit card and go and blow up their finances to try to have that experience, right? And of course, I'm going to say that, infinite banking is what allows us not to have to do it that way. We could still live our life now for the rest of our life without blowing up our finances by running up something on credit that we want to do, that we want to experience. And I think when I was hearing you earlier, Joe, Rob jumped in, and I love that we all have these different experiences. Rob or Tricia jumped in and started saying something about cost of capital, time value of money. They started saying something, but what I was hearing you say at the moment that you were saying something earlier was life experiences, like the value of life experiences are deferred. So at some point earlier when we were talking about deferred compensation, well, what does that really mean? Well, that means deferred experiences. So again, what I'm saying is both, right? Like, so if there is this YOLO ditch on this side, right? And if we decide that we want to stay out of that, over here could be this miser ditch. I would also say that it could be the inefficient. And again, I should have typed that instead of draw probably, okay? But y'all see what I'm saying? So like these are 2 macro level, I believe, ditches in life when it comes to personal finance. Do you take a credit card and blow up your personal finances for the next, 5 years, 10 years to try and make up for, creating that experience for yourself and your family or whatever? Or do you do something that's just, and I don't think that's the majority of people that are over here in the miser sense, right? Like they're probably not putting 90% of what they earn anywhere, okay? But maybe they're in the more inefficient category. Whereas, infinite banking is this middle road where I'm going to say we're living life now, Tricia. We're creating experiences now, right? But yeah, right. So if you're going to do it and do it well, it has to be with good stewardship, right? You're either going to be an honest banker or you're not going to be an honest banker, and that's going to create problems that are privatized. They might be privatized, but there's still problems that you're creating for yourself, right? You just don't have the bank, let's say, trying to pull collateral out from under you, et cetera. So that, again, will point us back to our characteristics part of the conversation that I still want to get to on these different products as well. But at a macro level, I don't know. This was the image that I'm seeing in my mind where, infinite banking's the middle of the road where you get to live life now, but you don't have to defer, compounding that you could experience at the time. You get to have the benefit of all this stuff. So let me quit sharing my screen, I think, because, well, you know what? That's gonna provide humor to people that are watching this. Is what that's gonna do, because they'll be able to pick fun at me. But that's helpful to me, and that's something that I like to do. Is I've actually drawn out a good bit of stuff here, and diagrammed it in a certain way. I had a pie chart earlier, like when we were talking about these different people, and I think that's terribly interesting. I'd love to know if we could have a pie chart. 5%, maybe just do something completely out of the box. They're living in their own financial world, whether they do infinite banking or not. They've created something that's it's different. They're not doing what's normal. And then, so what percentage? Is it 20%? Is it 35% of those people that want to shirk the responsibility, Rob, that you were talking about? That maybe they like control, but they're not, willing to actively or intentionally or purposefully do something for themselves because if it doesn't go the way that I want it to, then I'm the one to blame. And then there's that percentage of people, I think it was you started it, Tricia, that says, oh no, the government's got me. This is what everybody does. I'm just, I'm on the conveyor belt of conventional finance and everybody does this. The government's going to, this program, that plan, this aid, whatever, etc. Was there another one? Was there another kind of person that we mentioned earlier? People that want to shirk the responsibility, people that just trust the government, people that are willing to think out of the box, whether they know about infinite banking yet or not. They're just out there being creative, right? With HELOCs or like they're trying to do something different, right?
I give those people credit because they're actually trying to do something. They're they're acting upon what they believe to be the right process. But like what Joe was saying earlier, a lot of times they're starting from the wrong aspect. They're starting product first or something along those lines, or maybe they found the process or they found a process that they think works, but they fundamentally missed the problem. And I think that's what Nelson did so well in helping us understand banking is the fundamental problem when you're talking financials that most people just have no clue about. And I think most all of us were in that boat at some point in time. I know I was, where I didn't know that I had a banking function in my life that needed to be controlled, or I was giving that up. And that by having that fundamental understanding of the problem, it changes everything. And it just fits so well into what Nelson says, when you know what's going on, you'll know what to do. Well, if you don't know what's going on, you'll try a lot of different things, just like I did, just like many of you have, where we think we're going in the right direction, but ultimately we're going to hit this point where either control is going to come into play or things don't go the way that we wanted. Something's going to happen. And because we haven't fully understood the problem and we're trying to apply these different solutions to get where we want to go. And, it's just a matter of time then until we find out that may or may not work.
People that doubt themselves. That's maybe another section of the pie chart. You said that earlier too, Tricia. People that actually believe, I don't know anything. I can't do. No, I'm just gonna, that group of people. So this is the hard part for us as professionals, I think too, is, I thought about that group of people, Tricia, when you were describing them, but I loved how you were describing the mindset of that person who doubts their ability. I think those are sometimes the people that we'd like to work with the most, that we'd like to help the most, because maybe they are the ones that need it the most, because they're not at least trying to be creative, Rob, right? Like they're not even trying because they do have that self-doubt or whatever. And they're maybe not the sliver of people that are just doing something, completely wild and independent or whatever. Again, outside of infinite banking. But they're probably the same people that, are okay being plugged into the matrix, if I use my own language right there. And that's the hard part, right? It's like you can't want it more for somebody else than they can want it for themselves. All right, at the end of the day, Rob, you said it. Everything is finance, one way or another. People can do things conventionally, and lots of people are. Where do we go from here on process before we maybe jump on that original question of your fella telling you, Tricia, can't you just do this with an IRA? Because I think we're going to eventually need to, let's tackle, bullet form some of those characteristics. But you're both raising your hands. Go, tell me what you're thinking. Tricia.
I just didn't want this to go further without at least quoting Nelson on this out of becoming your own banker. Because I think we have to think through this. It says, when government creates a problem, onerous taxation, and then turns around and grants you an exception to the problem that they created, any tax qualified plan, aren't you just a little bit suspicious that you're being manipulated? And, that's to me, that quote just comes back to me constantly when I think about these qualified plans. They're not built for our benefit, but we're so convinced they are. But then that goes back to a little bit of what you just said, Jesse, with people who are comfortable being in the matrix and not willing to see, or not really understanding the root problems at base, right? Like, we would rather blame all of our economic problems on the greedy capitalist or whatever, right? And not realize that a lot of the base problems to our money problems is the banking system and the tax system. Those two pieces together are huge losses to our financial well-being.
Joe?
I think you had just mentioned, or sorry, Rob just mentioned you finance everything you buy. And I think breaking that down for a client or prospective client or just watcher of your YouTube channel, we're basically saying you're always borrowing. You're always borrowing. Like, there's always an interest somewhere. Right? You're either paying it outright to a third party because you used their capital, or you're using your own capital and sacrificing the growth. So you're borrowing it from your future. You're always borrowing, whether you're cash or debt, you're always borrowing. And I think the other half of that, like, there's always an interest and there's always a payment. You're always either repaying them or replenishing your savings. You got to keep that in mind. There's always a payment and there's always interest. You're financing everything. I think if you start with, we talked about it already several times, the problem being a cash flow problem, it kind of breaks down into four main categories, for me anyway. The problem exists, like inflation. I'll just say them outright and just kind of explain what I mean briefly. But inflation, there's an opportunity cost, there's taxation, and then there's control or custody. Those are the four problems with the cash flow. Inflation being, once upon a time when you saved $1 and you came back to your savings, the dollar still purchased the same thing. You didn't have to be a genius. You could just save and you'd be able to spend through time the same, because the savings had the same value. Somewhere along the line that changed, where our dollars wither, they atrophy. So you can't just save, you can't outsave this atrophying effect. Not traditionally anyway. So that forces us to say, what do I do with my money? Where should I put my money? My money's got to get to work. It's a natural reaction to the idea that your savings is like an ice cube that's just melting, or snow cone on a hot summer day. It's just melting.
And you have to put it to work just to keep it equal.
Oh yeah.
Yeah.
You have to take on tons of risk to try and keep the same purchasing power.
Yeah,
The opportunity costs. Oh, go ahead.
I was just going to say $1 today is the equivalent of about 2 cents in 1912.
That's right.
Like, that's, I mean, when you put it in that context, it's pretty sad in terms of how much that purchasing power has been robbed from the average person. And that money did go someplace. It's not like, well, it just withered away and went and it's gone, right? No, somebody took that capital out of the system. That's what people a lot of times people don't understand about inflation and how that works, is that capital's being drained out of the economy and it's going someplace else. But I mean, that's a different conversation, so I'm not going to go deep into that. But that money is that value is going somewhere, and it's going to someone or some persons, and we have to try to protect that the best that we can. And that's part of some of the process and stuff that we do, but professionally speaking. But it's so often, and I think that it's become more and more prevalent today, where at least people are becoming more open to understanding that is this big sort of silent killer out there for your financial life, and you have to do something about it. or, like Joe was saying, that dollar isn't going to buy what you think it is, 10 years, 15 years. And if you're only, going back to your previous mention earlier, Tricia, if I'm planning to buy something in 20 or 30 or 40 years without saving only 5%, well, that volume isn't going to cover it. And that's going to be a strategy of hope that it grew to the point where it's going to allow me to purchase what I think I could purchase. It's just going to be gone. So, yeah,
And to add to what you're saying, is it any wonder it takes two people in a household to be both, parents working, in order to keep up with this inflation. And then on top of that, you have this government qualified program with money you can't touch. I mean, to me, that's just exacerbating the problem. But I digress. Go for it.
Well, so one of the impact Rob's talking about, and I'm going to butcher the name of it. I think it's Cantillon, the Cantillon effect. The people that receive the purchasing power first. So the impacts of inflation are disproportionately spread throughout the economy. The people that have the dollars first get all of the purchasing power. Well, at a me and you level, the fact that we can look back 10 years and say everything cost less back then, and to know that it's part of the system, it's not broken, it's a feature of the system. We know 10 years from now, everything's going to cost more in terms of purchasing power, right? That is weighing on your cash flows. The next thing is the opportunity cost, that dichotomy we talked about, compound or spend. Spend, can't compound, compounding, right? You have to choose. The opportunity cost is a big problem on your cash flow, probably the biggest of the four. So we got inflation, we got opportunity cost, taxation. Tricia highlighted like 10 times over. But that it's a public system designed to redistribute resources and influence your behavior. She just said, if they cause the problem, then they create a kind of a solution. Aren't you being manipulated there? Taxation is a control mechanism. Another control mechanism is the custody of your capital. We willingly, unknowingly, and willingly give our capital away to these companies, these institutions that we cannot readily get back. And because of that, the scale is bifurcated. The scaling of our capital, this money is going to education, that's going to retirement, that's going over there. This can't be spent over here. It's like you're cutting your capital off at the knees. Those four problems are the cash flow problems. I say this all the time, that's the quadruple bypass Nelson talked about. When you're doing the heart transplant, what you're doing is you're removing yourself, you're circumventing this system into a healthy system with a healthy heart that bypasses inflation, it bypasses taxation, it bypasses opportunity costs, and it bypasses, like, you are in control of the custodian. It bypasses the control. Now you're free. There isn't, like, when you put it that way, do you want this system that's dying and withering and atrophying and all the problems and risk, or do you want this free system? The peace, the system of peace, relief, the system of a tailwind that's going to propel you wherever you want to go.
Which brings me to James Nethery's quote, "The premium is the solution," because you're putting it in that system that is the healthy system you just referred to.
Yeah, so I just, when I say premium, when I'm describing that to people, you can think of it like an exchange. You're exchanging these inflation poisoned dollars. You're exchanging them through paying. The premium mechanism is an exchange to this contract, this wonderful, beautiful, friendly, lovely tailwind contract. The door is the amount of premium you want to pay. You want to exchange for that. You can get, that's how fast you want to do the transplant. Sorry, Jesse, go with your saver, borrower, zero line. One other thing, sorry. You mentioned the experiential economics. Hey, we have to take that into consideration, and nobody does because it doesn't show up on a spreadsheet. There's a book where the person doesn't understand this, but they understand the experience side of that money. It's called Die with Zero. And what he does is he'll take net worth and plot it over time and then compare it to your health and say basically what Tricia said. They're only 10 once. They're only one once. You can't reproduce an experience that they should have had when they were one when they're 45. It doesn't work. They will not get the same dividend out of that experience when they're 45. It has to happen when they're one. So if you skip that, you've got to deduct that somewhere in your calculations here. I love Jesse's little diagram to say IBC is the remedy there, where we could still compound and capitalize in the personal side. What doesn't show up in a ledger or in a spreadsheet. The other book that comes to mind that kind of hints at that, I haven't read all the way through it. I think it's called Permission to Spend. It's that idea that your capital will continue compounding while you get to enjoy the capital as it's compounding. You're not forced into that opportunity dichotomy. Should it compound or should I spend it?
Mm-hmm.
For my part, it's a good conversation for me when we're talking about infinite banking, parenthood, the Bible, and all these things. I love it. Yeah, no, I remember when I first saw this visual, how it was helpful to me, Joe. So I was just trying to scribble while you were talking about, those two conventional routes of spending. If we're back at the top and we're saying you use money in one of these two ways in your life, that's what it looks like. And that helped me. That helped me to see that, okay, well, to do this, I got to ask somebody permission. And when they qualify me, if they qualify me under whatever terms or conditions and hold whatever collateral over me, I go down here, right? I'm below zero, okay? Zero meaning literally no value, right? Like no ability, nothing. We go below nothing, right? And then we pay interest to get our way out of here to just get back to zero. To me, when I just saw that, it was helpful, right? And we operate in a world, visually where people hear about illustrations and want illustrations maybe and make choices off of illustrations. So I feel like, conceptual illustrative stuff like this is a great thing for those visual people before we even get to, those details. Personally, that's what I do, is we need to understand the concepts, then we can get to the details. But then ultimately that still leads us back to zero, right? What does that do for us moving forward? Well, we're back at scratch. So I don't know, will they qualify us the next time? What will the collateral be that they'll, deem as necessary next time because they're the one in control, and all that kind of stuff. And then, the saving up of capital means foregoing experience again, right? Foregoing experience again. We're looking to live life in the meantime that we're talking about. I'm telling y'all, are making me think about my kids. You make me want to, as much as I enjoy talking with y'all, get out of the office and go back home and let's go have lunch, right? But we got to forego some things to be able to lock this money up somewhere and not touch it, especially if it's in one of these products like we were talking about earlier. It's, it's not even able to be collateralized, etc., right? But again, at the end of the day, we're foregoing, building up time, money, all these things. And it still goes back down to zero, though, at the end of the day for those cash. And I know that a subject we're getting ready to cover is about borrowing. So we're going here, right? But those folks go back to zero. They liquidate it all. So that money's gone. All the money that could have earned in the future is gone. Can't get the time back. There's so much going on even right there with the cash route. And we're for sure I'm saying, and y'all can elaborate how you want. I'm saying there's this infinite banking way, right? And compounding. Here I am with my alliterations again. Credit's a root. Cash is a root. Compounding is a root. It is possible. All right. So if the problem is that everything's financed and most people are picking between option 1, option 2, we're trying to make them aware of option 3, of course, this morning. For those that have already implemented the concept, we're trying to help them level up by just sharing, our experiences. Oh, wow. And I get back to the screen and I see 2 hands raised. I'm already talking too much. Got it. But that's the process, right? We know what the problem is, I hope, at this point. Everything's financed, okay? You got a process of approaching that problem of everything being financed. Credit, cash. And we're saying compounding is also an option. And then I want to get to the characteristics, but you got, Rob, what you got, man?
Well, I was going to say Joe had his hand up first, so he can go.
I'll be quick. I think part of the system is to trick us into loving zero. The gratification we feel when we get back to zero. Paid off the loan. I bought that car cash. It's this, like, but what did you do long term? You didn't even think of it. We just love getting back to zero. People love zero. And it's like, man, you took a minute to realize you're like, if you started at 0 years old, your maximum potential over the course of your life, and then you went to zero, and then you went to zero, and then you went to zero, and then you went to zero. Like you're chopping down the tail end of the curve every time you do that. And we love it. And ironically, the qualified plans we were talking about, I will say probably off the top of my head, almost every financial product out there that was created in modern financial planning with the IRS code is designed to go to zero. It is not designed to go to the next generation, and certainly not to the 3rd generation. 529s are designed to be spent for college and zero. They were not designed to be passed from kid to kid to kid to the next kid to kid to kid to kid, right? It's not designed for that. 401ks, now there's a 10-year window where the beneficiary has to liquidate it. Only 10 years. They can't use it their whole life. They get crushed with taxes for 10 years, probably in peak earning years. If you think about the ages, when mom and dad pass and you're in peak earning, that's when you're going to be forced to take all this money out. It's certainly not going to be passed to the next. And the way you receive it cannot go into like your account. It's in this special inherited status account that has that rule, extra rules around it. We're tricked into loving zero, not realizing your ceiling should be the next generation's floor. We should be propelling way away from zero. We should never see zero ever again.
Proverbs 13:22, right there, right?
I was
A
just
good
about
man
to say it
leaves
too.
an inheritance to his children's children. We don't even think of that anymore. We just don't think generationally. And
so in this, just specifically what Jesse's saying, the compounding on this contract does not slow down with the debt. Debt is not a drag on this compounding curve.
right.
The repayment of the loan, it's baked in that you will be restored back to the compounding curve that you were originally on. You didn't miss a beat. You will realize your maximum potential. Sorry, go ahead, Rob.
Yeah, I was just gonna say, going back to Jesse's example before too, let's just say that's $10,000 a year at every one of those steps up, right? Let's say it's over 5, that's $50,000 that's flowing through. And let's say that's just for a car, using it as a simple example. It's 50,000 that's gone forever once you purchase that car, and you've made that purchase. Now you have nothing left for it. But through capitalization, proper capitalization, like what we're talking about, and allowing that to compound, not only do we have the 50,000, but now it's compounding year over year over year over year, and you get the car, and you still get back to that same curve that you were just talking about, Joe. And you're going to realize that, and you have something to pass on to the next generation, all because you were thinking differently just about a car. If we're going to use that as the most simple example, but now expand that out for your life. What about my vacations? You know, like Tricia was talking about. What about, you know, all the other things I purchase in my lifetime? Well, if everything's financed, maybe everything should be going into capitalization for as much as possible, so that I have that increased level of compounding over the entirety of my lifetime. And it makes it so much easier then to be able to pass on to my children's children, or even beyond, right? So that whole understanding of our thinking is what really has to shift. And when it does, and we see the problem, like we've been just been talking about, everything starts to change, and we can put ourselves in a position that we've maybe never thought possible.
It's so crazy good. I just wish you could, you just want to scream this from the mountaintops. People, take a look at this. It's so good. There's so many positives. There's no negatives. That's where people go, it can't be true. It's too good to be true, but it's true.
Well, let's go back to the things that people say then, Tricia. Let me give it to you like this. We've talked about the problem. We've talked about process. Okay. Let's talk about the attributes, the characteristics of the products that are out there. And we've talked about some of them, right? Here's the question, right? Can't you just do this with an IRA? And people could insert whatever right there. But here's where my list is at currently from our conversation. Control, meaning access to capital. Collateralization, it can be collateralized, meaning you can still experience that growth, and yet you can leverage that growth at the same time without one affecting the other as far as that trajectory of the growth. Compounding, the growth itself. Risk, how much risk are we assuming in this vehicle, in this product, in this entity? Timing the exit, right? Timing the exit. That was something y'all mentioned earlier. I believe that was Joe. How about certainty and guarantees? What level of certainty, what level of guarantee, if there are any, do we have with what it is that we're considering? Privacy, tax advantages, inflation. Is this a hedge? Does it even address inflation at all? What about litigation protection? Now, here's a good point for me to say, don't sue us. We're just having a conversation about education. But all 50 states have a level of protection for life insurance, which is what we're saying is, the ideal entity, the ideal asset. I'm saying a properly structured whole life policy from a mutual company that pays dividends is the ideal financial asset. And I'm listing its characteristics right now. And the last one that I wrote down so far was the legacy move, right? Because we talked about the death benefit, leaving an inheritance to your children's children. That's where I'm at. If y'all got others, I'd love to hear them, but I just wanted to verbalize. I mean, there are several characteristics that I think we could use as a filter to evaluate IRAs, real estate, CDs, money market, stock. Insert whatever you want, and I'm just setting this up to kick it back to y'all, right? There are lots of filters that we could layer over and say, well, does this get a check mark or an X mark? Does it or does it not have this? And then if it has this characteristic, what level? Okay, that's how I'm looking at the issue. What are y'all's thoughts about the characteristics of these different assets? We've talked about some of them. Go ahead, Joe.
I was going to say the first thing I think you have to acknowledge is there has to be cash flow. Starting with cash flow, how can it receive cash flow? So for example, I mentioned an IRA from your parents or your grandparents can't be smashed into your personal IRA. It gets reclassified with extra rules and a new title called an inherited such and such. Whereas something like life insurance, the death proceeds can be received as premium in the next policy. In fact, distributions from an IRA can be received as premium. Rents from a rental property, earnings, interest, dividend, royalties, actually all cash can be received as premium. The ability to receive receive cash flow should be another, whatever you're calling this scorecard thing, characteristic you would want to look for.
What about
does
creating
this-
cash flow?
Yeah, there's another. Yeah, so compound that. Say on the tail end, does it intrinsically create cash flow?
Passive income, even
Mhm.
particularly.
And I think if you go back to, I think we talked about mutuality, the idea of what side of the table does this thing sit on? If I use this product or contract, am I at odds with the company that it's with? If they make money, am I losing money? Or are we making money?
We are making money.
Yeah. I think if you start with the more important ones of that, it's like it's way more important to be on the same side than it is like a rate of return or something to that effect. This is a long-standing relationship that, like, to be able to receive cash flow is another big benefit of this that is not there in other types of accounts or other types of products or other types of contracts. I think that you could actually separate this into two lists. Like the first filter would be something like those really big items. And then it's like, okay, now that we got through that, whatever's left, yeah, do we want this litigation protection? Do we want this like compounding growth or the other things that you were saying? I think if you filter it in the right order impacts outcome. If you filter it in the right order, it will naturally point you to the right solution.
This is a great place. I think I'm just furiously trying to write notes, and I still didn't write down everything that I'm trying to keep up with what y'all are saying in the moment. I think a good prefacing characteristic is also what Caleb Williams calls the and. Okay, if somebody loves IRAs, I don't care. You want to put money in XYZ, I don't care. Great. I actually would say that you should do what you think you should do. I'm not going to tell you what to do. I'm saying you should be financially independent. If you say, I love this, great. It's a beautiful thing to recognize that with everything being financed, you can enjoy both. You could capitalize in a policy that you own and control for whatever it is that you're going to. All right, Joe's going to have a disclaimer or something that contradicts. Who knows, right? You could capitalize in this private entity that you own and then deploy capital from there to the real estate, to a CD, to whatever you're picking or choosing, right? So what you got for me, Joe?
I was going to say, go back to order impacts outcome. If you try and go with your IRA first or your mutual fund first, or you go such and such first, it's really hard to get to this. The only way to do it is to take your pie and say, all right, we're going to do a little bit less to that. We're going to put that sliver to this. And instead of being where it should be as the foundational element, you make it a piece of the puzzle. You make it a piece of that little pie chart. It's like if you start with this, you can do all the other financing things. All of the other things can come from this.
Mm-hmm.
But if you don't start from it, it only takes up this much. And I forget who said it, but it's like if you only put 5% in your 401k, like how's that going to do anything in the future? You put pennies in, you're going to have pennies later. Just speaking to the importance of scale and the volume of capital you want to flow through your system.
But see, that goes back to the dichotomy too, because in one breath you'd tell people, well, listen, yeah, don't do 4%, do 40%, because if you're going to go the 401k route, you better do it big. Or I mean, what are you really going to live off of? Like I had a conversation with somebody this past week. Started the 60s, okay, taking care of her mom at home, also adopted grandchildren and is caring for them as children. That's just where this person's at in life, right? Because hey, this is real, right? $17,000 in the 401k. I mean, what's that really going to do for this? And they're asking me, what should I do? Should I cash that? Should I, So again, not to say that any of this is advice, I'm just saying that's where that person is at in real life. And in my mind, I'm thinking, I mean, what's $17,000 going to do for you now, right? So in one breath, you'd want to say, well, listen, if you're going to go that route, do it big. But then that flies in the face of what we've already said about deferred compensation, deferred experiences, deferred. So again, it's like picking between the lesser of two evils, no matter how you're looking at it, if you're only looking at it in a conventional way, I guess is what I'm arriving at, trying to describe.
So the order, it comes back to your order. If you're paying yourself last, you've got a lot of problems. You've got a lot of really difficult decisions to make along the lines of what Jesse just said. If you're paying yourself first, if this is the first stop for all of, or the majority of, or a large chunk of your capital, you've got a lot of options. This is built around flexibility. This is built for peace of mind. It's the relief button in your financial life.
I'm glad you said that, flexibility. That's another one of the characteristics I just wrote down. Flexibility. I mean, we're at a big list, and I'll share this with y'all. And flexibility, scalability, and then that mutual relationship. So our list keeps growing. That's all I'm saying real quick.
So with that list, could we then take it and just look at like two major categories of where people put their money and compare it? Let's just say pre-qualified plans and real estate, even. Maybe, unless you want to add another one. I'm just trying to keep it simple, right? But if you went through and you said, okay, with real estate, what is the control, the cash flow ability, the what were some of the other things you had? You had 3 C's. Trying to remember, I wrote them down and I flipped my page. Compounding.
I had one more
the
piece to
risk.
scalability. In modern financial planning, even real estate, 401k world, mutual funds, scalability, growth isn't the same across the board.
Mm-hmm.
Like when you get too large, it gets really difficult to maintain a certain growth in that environment. In this environment that we're talking about, that doesn't exist. That problem doesn't exist. For example, you go look up the Warren Buffett quote, where it's the first million, doubling the first million's a walk in the park compared to trying to double $1 billion. When you have $1 billion, you have different problems of trying to find enough return to double the money. So as your capital scales the way we want it to and gets really large, or as you buy more properties, like you realize it's not scalable in a exponential curve. Your first property to your second, yeah, it feels like we're doubling.
Mm-hmm.
When you get to your 20th to 21st, the incremental change was not double what we're doing. It's not the same, like it's not an increasingly increasing growth.
Mm-hmm. Well, and I would say, as much as I love real estate, and I do, because of the, honestly, I think what people love about real estate is the leverage, right? You put it down 50,000, but you get growth on 250,000. You can create cash flows, you know, you've got appreciation, you've got somebody else paying the mortgage down. So you've got all of those kind of 4 things that you can use to grow wealth. And yet, right, it is market dependent. Your money gets tied up into a hard asset and you have to, once again, go to the bank. So once you have some equity in a property, you want to use and access that equity. You're going back to the bank and asking for permission, which may or may not be granted, which could be at a different interest rate, depending upon, you know, what's going on in the economy. Today, to access equity in my properties, I'd have to get a much higher interest rate. Not sure I want to do that. You know, there's all of those restrictions, lack of control, things that I cannot control. Still love real estate. I do, right? I think it's a great investment, generally speaking. But there are still things where that investment is better coming out of this whole life policy, because that has all of the characteristics I want. And from there, I can go and do this if I want to do that, right? Compare that with, and then I don't know, I was just kind of thinking, can we walk through? I think it looks like that's what you're trying to do there, Jesse. All of those different things with real estate and qualified plans or what have you.
I like this kind of stuff. I'm always writing stuff down, but typing, I'm sure, is going to be a lot better for everybody watching and for y'all. Yeah, I'm still putting down those characteristics, and then, you know, whether these things have them or not. Spoiler alert, everything that I'm typing, the whole life insurance is going to have, but here we are.
One thing that I'd like to add, especially for viewers and especially for people who are maybe skeptical and they're like, oh, well, you're just cherry picking these areas to make this product look better. It's like, no, not really. It might seem that way. It's just because most people don't understand to look at asset classes and look at things from a different perspective. If you're only looking from a limited point of perspective, like only from rate of return or only from appreciation, you know, whatever it might be, sure, that might be how, you know, one area might look better. But if you take the time to really understand the different problems, the things that we need to be looking at with virtually any asset that we're considering, we have to account for all these areas. And when we do, and we kind of, again, take the big picture approach and look at it, it will present itself and you will see it. And I would challenge anybody that's maybe thinking like, oh, well, you're kind of full of it. Well, go to Grok, go to Chat GPT and type in, you know, what asset fits all of these classes, and it'll do all the hard work for you, all the research stuff. It'll spit it out, and you will be very surprised at what that answer is. Now, I'm not saying those are an authority because it's an AI, and all of us have had that conversation before, but regardless, it does help us narrow things down quickly, and you would be quite surprised to see what it will tell you as as an asset class, which option fits all of these areas most effectively.
Jesse, I think you should put rate of return on there to be fair.
I would say I think the people that do that, rate of return, they fail to assess two extra components of return. They're only looking at return. They're not looking at risk-adjusted rate of return and cost-adjusted, risk-adjusted rate of return.
How do you like that? How do you like growth? Can I generalize it to growth? I mean, there's no question that growth is an attribute, I guess, is what I would point out, right? Is something going to grow or is it not going to grow? And then the answer is then maybe yes, no, maybe, qualifications, right?
I would also clarify compounding as uninterrupted compounding, because there is a difference in that.
Yes, sir.
Because there's a lot of people out there, they're like, oh, well, yeah, my IRA compounds. Like, well, not really. Not the way that you think, because uninterrupted compounding is completely different.
Thank you, sir. And then what were you going to clarify too, Joe? Looked like. I mean, this is a working list. Y'all tell me your feedback.
Put the other qualified plan up there as well in the column.
There's another column. Yeah.
Mm-hmm.
Joe, did you have something else you was going to add or clarify on the growth or the rate of return, buddy?
I don't know if there's an easy way to say what I was saying, but the idea that it's not just how much is it growing, it's how much risk you're taking while it's growing.
Mm-hmm.
Well, I do have risk as its own category, which I could see how you could point out risk on growth as a very specific thing. I guess I was trying to be fairly general and speak in layman terms enough. I don't, no, not that I think that, you know, all these words are like Rob was just saying, most people aren't necessarily talking about this stuff, and we've already addressed that. So all I'm saying is, in general, what are your thoughts about how I have it so far?
Do you want to qualify whole life as specially designed? Because it can be different. Or mutually
Maybe.
owned. Or we'll just say that that's part of what we're talking about.
Yeah, I'll verbalize that again. When I'm saying whole life here, and not that whole life doesn't have these characteristics, because it does. But is it optimally designed? Is it specifically engineered, for infinite banking from mutual companies that have a track record of paying dividends for over 100 consecutive years? Maybe, maybe not. So all those things are important. When we talk about whole life insurance for the implementation of infinite banking, we are saying that. We're saying whole life from mutual companies that pay dividends that's been specifically designed for implementation of infinite banking. How about that for a verbal?
Very good. How about liquidity or access? I don't think that's on the characteristic list. Maybe that's under collateralization.
Yeah, I would maybe just put collateralization / liquidity.
Mm-hmm. That's probably what kind of counts as the same.
I would, so maybe it's different. Access, like for example, Tricia was shared, to get access to real estate, you need to go to a bank to beg them for access. For a qualified plan, you need to beg the IRS and the plan administrator for access, and they'll only give you this much. Collateralization, I would say, for example, that's the ability to not interrupt the capital while getting a loan against the property. So real estate would be a big yes. You can use that property to get, 80% of the value or 60% of the equity, something like that. Qualified plans, and no, you can't get anything. It's baked into the rules. Whole life, you can get 95%. So it's I think you could do a check mark to make it simple, but it's different. Like real estate, there's a limit on how much you can get access to the equity because the bank needs a safety buffer.
Mm-hmm.
The collateral is so perfect with whole life, there's no real safety buffer. The safety buffer is there because they're calculating how much interest could come in the 1 year. We don't want it to implode, and it's a much, much smaller safety buffer.
Well, that's the difference between it being 100% reserve, right? It's you can do that, and when you're not that way in a bank situation with loans and equity and etc., well, then there's going to be a lot more rules.
All right, part of this seems, I'm not sure what it is. I have a feeling for what we're doing right now, which is actively constructing and conversing, which is maybe different than presenting, but it's neat. So here's what I'm wondering. How about we go down this list, unless you're diametrically opposed to it. We just take turns addressing that characteristic and then just describe it, define it, before we even address real estate, qualified plan, its whole life. Do you see what I'm saying? So this is crazy to say that a 2-hour-long conversation might have to have a part 2, but we're definitely, I feel like we're right in the middle of something right here, to be able to put a bow on it. So yeah, I've never been here. That's the neat thing about a round table. My goodness, we don't know what we're going to get into when we show up. It's just going to be riveting is all I know. All right, appreciate y'all. Man, right in the middle of things. This is like the worst cliffhanger too at the same time. This is the worst. It's the best and it's the worst. Never had it like this, and it's the worst. Thank y'all for being here. Appreciate it.
All right. Thank you, Jesse. It's always fun.
Yep.
Yes, it
Bye-bye.
is. All right, get you King James Version. See you later. All right, one more thing. Maybe this will make the extras. I don't know. That whole idea of somebody, realizing who can pull the strings when you're asking to do something, with money, you realize who really holds the strings at the end of the day. But as soon as I heard y'all saying that question, I'm thinking of what my response would be. It's like, well, what's the money for? Well, I'm taking your mom on vacation. I know, shame on me. All right, fine. That's just for me to be able to laugh at. All right, back to talking about the Bible, right? There you go. You learned something about me. Okay. All right, y'all's faces tells me that was one of the lines I just should have kept in my head. Y'all aren't ready for that level of humor. I understand. That's all good.
All right, so remind me, Joe. I feel like I should have asked this already, and I don't know how I couldn't have, but are you a King's guy or a Geno's guy?
You mean Pat's?
No, I
Pat's
mean
and Geno's?
cheesesteaks, Geno's or King's?
Neither.
Neither. Okay. All right. See, you got a third option that's maybe even better when it comes to cheesesteaks. I don't know.
So normally people the Pat's and Geno's is the core.
Pat's. Okay.
That's the
It's
rare
it.
one.
Pat's is the one that's across from Geno's. I've always gone to Geno's, so that's the one that I know for sure.
Wait, you've been in Philly? You haven't called me? That's I see.
Twice, but both times it would have been before I knew you. Both times it would have been before I knew. I didn't know you, man. Come on, come on. It would have been. I've been 2 times, but it was before I knew you.
Okay. I'm just gonna avoid your state from now on.
You'd have been busy skiing the slopes, snowboarding and such. Anyway, you wouldn't have been in there.
Oh, Rob, do you believe
Morning,
this?
Rob.
His family has a
Joe,
morning.
be quiet. Rob wants to say
after-
good morning to us.
Because how I had talked to you earlier this week about getting into the book of Job. No, I had started digging into that this morning.
Fantastic.
I only got about 5 verses in. So.
A lot happens fast in Job, though. So at the beginning, so
Well, because I have an ESV study Bible, so I was really digging in, and I read all of the
so
stuff
not a real
leading
Bible.
up to it.
I was gonna say, hey Jesse, how you feel about that?
Not a real Bible.
What are
I'm
you
starting
in
this
old
conversation
King
off
James
good,
version?
Right? Yeah. I mean, for English speaking people, yes.
What was this?
Oh my gosh.
I'm missing out on something here.
Rob was talking about reading in Job.
Right, but
this
ESV
morning,
versus
and
what? King James?
yeah, and I was digging at him about the version he was using.
Yeah.
They're all good to cross-reference against, especially when you're like really digging into study, if you can reference different aspects. But yeah, I all I know is the more I read, the more I study, the more I find out that the English language is really poor at using good words for description. We have one word that has 15 different meanings instead of 15 words that have specific meaning.
Mm-hmm.
So
I was getting ready to say it depends on what you mean by poor, because as far as like number of words, there's no language with more like just vocabulary, right, than English, if I'm not mistaken. But what you're saying is also right. Obviously, the one word can have so many different meanings or directions that it could, and yet we have so many of them at the same time. Interesting.
yeah,
I like Job. Job's and we're in baby picking name season here in my house, and we know it's a boy, and we know we want to have a J name because I'm Jesse, and then we have Jacob, and then we have Josiah. So Job is kind of in the running, but more for a placeholder in a way. I don't know that I could use it, but I love Job's story.
yeah.
I wouldn't
We
like him.
It's a would and wouldn't for me. I mean, It's
Right.
like life's hard for everybody. Life's hard for everybody. Stuff happens to everybody. I mean, my goodness, I don't know that more could happen than to what Jesus's life. But I don't think I shared this verse with either of y'all, but I've shared it with 2 or 3 people recently. And it's where Job says, "He knoweth the way I go, and when I come forth, I'll come forth as gold." That's not me quoting it. But I love that verse. Love that verse.
What does that mean to you?
Well,
Why do you love that verse, sir?
Refiner's fire. He wants to go through it.
No, I'm not asking for anything.
Come out the other end of it.
That's what I heard, actually.
I'm not asking for anything. Stuff's going to come no matter what. Either way, we live in a world that's cursed, and it has its own terrain, right? And then on top of that, we have a real and a living enemy, okay, and his followers. And then we have our own selves to deal with on top of that. And then, yes, I do believe that the good Lord will use He doesn't tempt us with evil, like Scripture says, but he does present us with, trials or opportunities, right? So, like, oh no, there's multifaceted attacks or obstacles in front of us from all of those different directions. We don't have to ask for any extra. All
What are you
I'm thinking
laughing
of
at?
is
What are you
ways to
smirking
dig
at?
at y'all now. There's not. I'll get serious when we switch gears, I guess.
I use
All I'm
the
thinking of.
ESV, Rob, so don't feel bad.
I knew it. I knew that. I didn't have to ask. I mean, actually, I figured NIV, Tricia, but I love you anyway. It's okay.
NIV is the nearly inerrant version. Isn't that something like that?
That's hilarious. I've never heard that. I've never heard that.
I use NIV.
You work at the church long enough, you hear all kinds of things.
For sure. For sure.
Hmm.
All right. So I do hear Tricia great. And see you all real good.
If this video was valuable to you, make sure to let me know with a thumbs up, and I'll see you at durhamtalents.com. Live and leave a lasting legacy.